Hello class, this week we're gonna start chapter 10, okay? Chapter 10, liabilities. Now let's work on the lecture, okay, the PowerPoints. So what is liabilities, right? Liabilities is actually something that we own right now because something that we did in the past, and then in the future we're gonna sacrifice some assets such as cash specifically, and to pay off these liabilities or offer some products or services in the future. Okay, so basically that is due to the past transactions, then we own right now, we owe right now to somebody something in the future. Okay, and for example, if let's say employees worked for us for the last month, and right now we are owing our employees their salaries, and we're gonna pay their salaries probably 14 days later or a week later. Okay, so or we've done a business for the past year and we earn some operating income and we have some positive bottom line, which is net income, and then we're gonna pay some income taxes to the government, right? And that is due to the past events, the business operations. Now we owe some taxes to the IRS, then we're gonna pay it later, probably 3 or 4 months later. Okay, so these are liabilities. And in terms of liability section on the balance sheet, this is how we're gonna report, right? So I'm not going to go through all these sections, but you need to understand what will be reported on each section on the liability section. Okay, we have current liabilities and long-term liabilities. Okay, and you have to separately list out all these different liabilities under its appropriate places. Okay, and have these numbers. All right, so classification. Liabilities, we have long-term liabilities and current liabilities. And current liabilities, as we know, those are the liabilities we need to pay off within 12 months, right? And long-term liabilities are those things we don't have to worry about pay off within a year. So we need to pay off some of those liabilities in the time period of longer than a year. So that is long-term liabilities, okay? Okay, current liabilities, when a company receives goods or services on account and our liabilities increase, we're going to debit or credit liabilities because we owe our customers services or products. Once we deliver the products or offer the services, then it decrease our liabilities and we're going to pay it off, right? And then we're decreasing it by debiting liabilities, okay? And besides this, we have all these different accrued liabilities. So what is accrued? You need to go back to review chapter 4 if you don't understand what is accrual, what is a deferral adjustments, all right? So accrued liabilities are those liabilities has been incurred but we haven't paid off yet. Okay, we haven't paid off yet. So we have to record all these liabilities transactions, and later on we're gonna pay it off. Okay, at the time when we make these journal entries for those activities happened, and those liabilities are accrued liabilities, right? And in terms of accrued liabilities, here are some examples. We have accrued advertising, accrued payroll, accrued income taxes, accrued interest, and some other accrued liabilities. Okay, so what is our accrued? That means we have utilized some resources or something from third party. Okay, either our employees or our partners, or we earn operating income, and all these things we have earned, we have something need to pay it off to these corresponding parties, and those in the future, and those are accrued. Okay. And what are those? So when it's come to make journal entries, and probably your question is, how do I know which accrual that I'm working on, right? So that is not a question you need to worry, because when it's come to the questions, and you know which type of these accrued liabilities journal entries you're working on, because it will be very straightforward. Okay, for example, if you said it's advertisement something, and it will be accrued advertising liabilities. If you're paying your employees, and those has to go through payroll, right? So they'll become accrued payroll liabilities. Or income tax basically is when companies pay when company calculate their income taxes, right? Accrued interest, so on and so forth. All right, so now let's look at what is payroll liabilities. Okay, So payroll liabilities, we have two things. First is payroll deductions. Second one is employer payroll taxes. Now let's look at these two separately. First, payroll deductions. Okay, payroll deductions. Oops. All right. You can see this. Okay. Payroll deductions. Okay, payroll deductions. Payroll deductions are those things that you need to pay it off to the federal government or local government and voluntarily requested by employees and create a current liability for the companies. And these include income taxes and FECA tax, some other deductions. Income taxes, that is basically how much you earn, and based on that, you need to pay your income taxes. To the IRS and to your local government and the state government, right? And the second one is FECA tax. Basically, that is your social security taxes and Medicare. Okay, those two are used for your retirement payment and your retirement medical insurance after retired. Okay, and other deductions like charitable donations or union dues, those things. Okay, so we pay income tax and we pay two different income taxes in general. Okay, one is federal income tax and the other one is state income taxes. For federal income taxes, those taxes paid by us, and federal government collect them and use these money for militaries, FBI and CIA, U.S. Postal Services, and for state government we pay state taxes, and those money collected by state government and will be paid for state troopers, police, and something like fire departments or state departments, okay, whatever. And then whatever that is ran by state governments, okay, and FECA and other deductions, okay. So here, after we have worked for 10 let's say a year, and we earned $50,000. Okay, let's say we earned $50,000, and for that $50,000, do you think you're gonna earn that? You're gonna receive $50,000 paycheck? Okay, no, you're not gonna receive that $50,000 paycheck annually, because that is your gross income, and all of these things, income tax, FECA tax, will be calculated based on your gross income using some percentage. Okay, so for FECA, the Social Security tax is one of FECA tax, and that is about a 6-something percentage of your gross income. Okay, for example, your gross income is $50,000 a year, and your Social Security tax will be let's say 6.25% out of your $50,000 will go to go to Social Security tax. And for Medicare tax, that is 1.67 or 1.65% out of your gross profit. Okay, gross income. Okay, and after we deduct all of these taxes, and you're gonna have something called a net pay, which is your take-home payment. Okay, take-home payment. So basically, when you have $50,000 salary annually, and you're gonna receive less than $50,000 a year, that is your work-home payment. Okay. And that part is all these three things is responsible of employees, the person who actually earn salaries and wages. Okay, who actually earn salaries and wages. But for simplicity, your employers will hold off part of these taxes for you, okay, from you, and for the governments, okay, for federal governments or for state governments, whatever, okay. So they're gonna hold this for them from you, okay. So that means at the end of the year, when you file your tax returns, you don't have to pay a huge amount of taxes at one time, okay. So eventually, as each paycheck you receive, and your employers will deduct those things from your paycheck and withhold them for tax filing purpose at the end of the day, and those things will be paid through the company's accounting system. Okay, so that is called tax withhold. Okay, with tax withhold, that is the term for that. Okay, but employers will withhold these taxes from you and for the government. Okay, and besides that, the company itself has to pay some payroll taxes as well. Okay, so before that, let's look at the payroll deductible example. Okay, so here you see this is the pay stub. Okay, pay stub, and you have this check. Okay, on the top. Okay, now most of us is doing direct deposit, but the first check always going to be payment is always going to be a check. And here is the breakdown for how much how much taxes you need to pay, and how much expenses you're going to have. Okay. So let's say gross earnings. So in this case, the person worked 40 hours, and hourly rate is $15 per hour. So in total, you earn a gross payment of $600. But out of this $600, you're gonna pay some federal income taxes of 60 something, and FECA taxes of something, and other something, probably just your donation or your health insurance or union dues. And total, these deductions are $116.80. So after deduction of this 100 something, and your net pay is $483.20. Okay, $483.20. This is your walk home payment. Okay, so this is actually the amount of money you can really spend anywhere else, anywhere you want to spend after you receive the check. Okay. All right. So gross pay and payroll deduction. So this payroll deduction will deduct from your gross pay. Okay, even though you earn $600, but it is our employees' responsibility to pay off these to the federal government and to the local government, right? So we have these based off some percentage calculation. You're gonna pay all these things and add these up together. Your total payroll deduction is 116.80 cents, and then 600 minus this total deductions, and your net pay is 483.20 cents, which is exactly the same here as the net pay. All right. So accrual example. Okay. So when it's come to that payroll stuff, and for this payroll deductions, we're gonna make all these journal entries. First is our the company's salary and wages expense. It doesn't matter if it's gross pay and what do you have to pay to the government. It is employees' responsibility, right? Employees earn $600, and this is their responsibility to pay their income taxes, to pay their fees to the government, right? So it is not a company's liability. However, here is that we have paid employees $600, okay, $600 per person, and it is company's salary and wages expense. Okay, and in this case, we have 1,000 workers. Each one of them is earning $600. So in total, that is $600,000. Okay, so that is $600,000. Okay, so that is our salary expense. Okay, I don't care how much employees has to pay to this to the governments, but this is what we paid to the employees. Okay, then it becomes our salary and wages expense. When it's expense, we debit salary and wages expense, and then credit all these things. And what are these things? Withheld income taxes payables, FECA payables, United Way payables, and cash. So basically, we paid employees the take home net pay, which is $483,200. So this is net payment that employees receive, the walk-away payment, and all these are withhold. Okay, even though that is called withhold income tax in FECA, there's no withhold that word in front of these two terms, but all these things are are the amount we withhold from the employees, and we're going to pay it for employees to the federal government and the state government in the future. So that is our liabilities to pay these to the governments in the future. So that is why it is a payable, because we collect all this money from employees, okay, and on their behalf we paid off to the governments in the future. Okay, so then it becomes our liabilities. It's a payable. That makes sense? Okay. All right, and now it's something called employers' payroll taxes. Besides those payables that we, on behalf of employees, we're gonna pay to the IRS, to the state governments in the future, the companies itself has to pay some payroll taxes as well. Okay, so first, employers has to pay is FECA tax, and it's a matching contribution. Okay, so if employees is paying 5% of Social Security tax, then the company has to pay the same percentage of Social Security taxes, okay, based off on the employee salaries, okay. And if it's 1.65% of Medicare taxes, if company is going to pay exactly the same amount of taxes, that is why it's called matching contribution. Okay. Other than that, companies also has to pay federal and state unemployment taxes, and all these are required. All these are required. The prior one is the taxes we hold from employees and on their behalf to pay to the tax agencies, tax offices. But here in this section, all these things are employers' taxes. Okay, are employers' taxes. So assume General Mills was required to contribute $45,900 for FECA and an additional $4,750 for federal and state unemployment taxes, and now is become our liabilities. FECA payable, unemployment taxes payable, these amount, and then we have incurred all these payroll tax expense. Okay, all these coming together called payroll tax expense. Okay, then we debit payroll tax expense for $50,650, and then credit FECA tax payable and unemployment tax payables. And I know here we have all these similar terms using for employer payroll taxes and for accrual payroll examples here, but we are using them for different purpose. Okay, we are using them for different purpose. Okay, so here is the payables for employees taxes, okay, and here is for the company's taxes per se, okay, itself. All right. Okay, accrual income taxes. Corporations calculate taxable income by subtracting tax allowed expense from revenues, and this taxable income is then multiplied by tax rate. And for companies now, it's most of the percentage we use is the common percentage we use is 35%. Okay, so in this case, company earned $1 million, and the income tax is 35%, and that is $350,000. And then because we're gonna hold it off and pay it later during the tax season, okay, so we're gonna have this journal entries. Okay, all these are accrued. Remember, all these are accrued because we have these transactions happen before we make all these cash transactions. All right, so we debit income taxes expense and credit income tax payable. Okay, income tax payable. Why payable? Again, we're gonna pay that later. Okay, during the tax season. Okay. And notes payable. Okay, notes payable, we have all these things, and notes payable is 99% exactly the same as notes receivable. Okay, notes receivable. Notes payable, notes receivable are very much similar. Besides that, we're on the different side of that transaction. Okay, for notes receivable, we are on the seller side, right? For notes payable, we're on the purchaser side. Okay, so we have this establishing notes. This note accruing interest incurred by not paid yet, and recording interest paid and recording principal paid. Okay, and So establish the notes on November 1st, November 1st of 2018. Assume that on November 1st of 2018, General Mills borrowed $100,000 cash on a 1-year note. So that means it's a current liability, right? Because it's 1 year. It's not longer than 1 year. Okay, that required General Mills to pay 6% interest and $100,000 principal both on October 31st. When we have established this notes payable on November 1st, we have received $100,000 cash, right? We have received $1,000 cash, and we have created liabilities to pay off this $100,000 principals in the future, which is on October 31st, 2019. So then journal entry is debit cash, credit notes payable, right? And then accrual interests owed but not paid on December 31st, 2015. Okay, so come here again. 2015. Okay, so that should be 2018. Okay, December 31st, 2018. Let's fix it. Okay, that's 2018. Okay, so here we established the note on November 1st, 2018. Now it rolls to the end of the year of 2018 when we have to make the financial statement for the year, right? For the year, then we have to recognize the expenses for using that note, $100,000, but we haven't paid interest or the principal yet. On this date, we have to record accrued interest expense, right? So using that formula, okay, interest equals principal times interest rate times the time, the length of time that we use this money for. Okay, so it's principal $100,000 times the annual interest rate 6% times 2/12. That means it's 2 months out of 12 months. Okay, and this is the $1,000. That is the interest expense for using that $100,000, the principal for 2 months in 2018. And now we need to make the journal entries as debit interest expense $1,000 and credit interest payable for $1,000. Okay, so I don't want to go through, and I don't think that it's necessary to go through all these journal entries, the theoretical points behind all these journal entries. Okay, if you don't, or if you have difficulties to understand the increase, decrease section for direction for each one of these accounts, go back to the first 4 chapters to review those definitions and concepts. Okay, I know it's a long time. And after that, record interest paid on October 31st, 2019. When it's come to mature, the notes, okay, the notes come to mature here on October 31st, 2019. We have to pay off both the principal and interest. Okay, remember interest, it is a year interest, which includes the 2-month interest expense in 2018 and a 10-month of interest expense in 2019. Okay, so now here is the journal entry with debit interest expense and debit interest payables, and then credit cash for $6,000. $6,000 is our interest expense in total. Okay, so but you see here we have 2 different entries on the debit side. One is interest expense, one is interest payable, and that is because we are making these journal entries on October 31st, 2019, which is in the year of 2019. So we have to recognize the interest expense for this money used during 2019, which is 10 months, right? Which is 10 months. We use the money for 10 months in 2019. We have to recognize the corresponding expense. But this interest payable is rollover from the prior year, right? The year of 2018, when we established this notes payable and we use this money for 2 months, which the interest expense of this 2-month use of notes has been recorded in 2018, excuse me, in 2018, that $1,000. Okay, and by the time December 31st, 2018, when we recognize the interest expense of $1,000, it is our liability to pay it off in the future, right? And remember, for these notes, both interest and principals has to be paid off on the maturity date which is October 31st, 2019. So now it is the time to pay off the prior liability. So now our interest payable decrease, decrease. And in total, our out-of-pocket payment for interest, that is $6,000, okay? It is only, this journal entry, it is only for interest payment, okay? For interest payment. And for the principals, we paid principals of $100,000 cash, and then our notes payable liability will decrease, so debit notes payable and credit cash for that amount. All right. And besides the income payroll taxes and income payroll liabilities and those interest liabilities, we have sales tax payables. And I think everybody understand what sales taxes is, right? What sales taxes is. So for example, Best Buy, when you go to Best Buy, buy something and that costs you $100, you don't just pay that $100 that shows on the price tag, right? You have to pay that $100, the cost for that product. On top of that, you have to pay a certain percentage of income sales tax, right? So you're basically going to pay more than $100. Let's say it's $105. Okay, so that $100 goes to Best Buy, and that $5 tax will go to the government in the future, right? So those $5 is sales tax. Okay, so why is called why is called tax payable? Because again, company will collect all these sales taxes all together for a certain period of time and pay it off to the government at the same time. They're not gonna have each sales transactions and pay them separately per sales transactions. It doesn't make sense, right? Because it's not very efficient. Okay, so that is why we have to pay. We have to hold on these sales taxes, and it creates a liability called sales tax payable. Okay, and we'll pay it off someday in the future. Okay, and deferred revenue. Okay, if you remember this in chapter 3, deferred revenue is we receive the money from customers, and we own the customers, and we're gonna provide products or services in the future, right? So those are deferred revenues. All right, so. Sales. Best Buy sells a television for $1,000 cash plus 5% sales tax. So the sales tax collected is $50. Okay, in this case. Okay, and then we will have this journal entry for recorded for the sales transaction. We receive cash, debit cash $1,050, and credit sales tax payable. Okay, because we are holding on these taxes and gonna pay that in the future. Okay, when we have more sales transactions and pay them off together at the same time. Okay, so that is called sales tax payable, but it has to be paid off within a year, right? And that's $50, and those $100,000 for the products is our sales revenue. Okay, so we debit cash and credit sales tax payable and credit sales revenues for the corresponding amount. All right. And in January, Live National Entertainment received $8 million cash for advance ticket sales for 2 concerts to be held on May 12th and the 15th of the same year. Okay, so one is in January when they receive this $8 million cash for advance tickets. Okay, for the 2 concerts in the future. Okay, we receive cash, but we haven't performed the concert yet, so it creates a liability. It's called deferred revenue or unearned revenue, right? So then we'll record this journal entry: debit cash $8 million and credit deferred revenue for the same amount. And when it's come to May 12th, the concert is held, and we can recognize half of deferred revenue because we already performed half of the obligations by performing one of the concert, right? So after this date, after the concert has been successfully performed, and we can make the following journal entries by debiting deferred revenue for $4 million and credit sales revenue for $4 million. And now we are able to recognize, to earn the revenue, right? Following the revenue recognition principle, and decrease our liabilities by $4 million, okay? All right. So current portion of long-term debt. So we have long-term liabilities and current liabilities, but some of the long-term liabilities will become will become short-term liabilities when the maturity date of those long-term becomes shorter than a year. Okay, so current liabilities not only include those tax payables, payroll payables, or deferred revenues, but also includes those long-term liabilities that now the maturity date becomes shorter than a year. Okay, so two sections, and the others, the liabilities have a maturity date longer than a year that has still staying in the long-term section of liabilities. Okay. All right, now let's work on some practice problems. Okay, so let's go back to right here, the whiteboard. Okay, so this is the practice questions on your textbook as well. All right, so calculate net pay and total payroll. Total payroll. Let me see if I have this. Okay. All right, so the company is a mid-sized manufacturer of the batteries, and the company's payroll record for November 1st to 14th pay period shows that employees earn wages totaling $50,000, but employee income tax is totaling $7,000, FATCA tax totaling $2,625, withhold from the amount, and net pay was directly deposited into the employee's bank account. And what is the amount of net payment? Okay, assuming the company also paid $250 of unemployment taxes for the period, what is the amount to be reported on as the total payroll costs? Okay, so the gross payment, the gross salary. Gross salary is $50,000 for employee, and out of that, the employee has to pay employee tax. Okay, and has income tax of $7,000, and also the FATCA of $2,625. Okay, and those are withheld by the company, and on behalf of the employees, company will pay these amount to the taxes agent's office in the future. Okay, so $50,000 minus $7,000 and minus $2,625, and the net pay will be $4,000. Net pay is $40,000. Excuse me. $375. Okay, so this is the net pay. This amount of net pay that employees will walk with to home. Okay, and what else? Okay, and also the company has to pay $250,000 unemployment taxes. Okay, so remember company. Then this is the company tax. Okay, so remember, not only employee has to pay these taxes, but the company also has to match with the FATCA tax. Okay, with the FATCA tax, not the income tax. Okay, with the FATCA tax. So that means if the employee is paying $2,625 of FATCA tax, companies itself has to pay a FATCA tax of $2,625 as well. Okay, so besides this amount, company also has to pay $250 of unemployment. Okay, unemployment tax. Okay, so in total, the company's payroll tax is $2,625 $5 plus $250, and that is $2,875. So that is the company's payroll taxes, and that will be the employee's tax. Okay, the employee's tax. But back to this question. How much is the net pay? Right? How much is the net pay? Okay. How much is the net pay? And the net pay is this, for $40,375. And in terms of total payroll cost, okay, payroll cost. If you don't know what cost is, this is payroll expense. Okay, a payroll expense. Okay. In terms of the company, the payroll cost is $2,875. Okay, $75. Okay. The payroll tax. Okay, and then the payroll expense. Not only we have this payroll tax, but also we have that salary and wages expense, right? And how much is salary and wages expense? That is $50,000. The salary we paid to the employees, the total salary and salary wages. Okay, so the total payroll expense, they'll include both the payroll tax and the salary expense. So in total, that is $52,875. Okay, that is the payroll cost for the company. All right, and now let's look at the other question. Refers to the question above. Okay, prepare the journal entry or entries that a company would use to record a payroll, include both employees and employer tax. Okay, so now let's do the employees tax. First. Okay, the employees tax first. This part. Okay, this part. And for this part, the employer will record the following journal entries. Okay, so first of all, the employer has incurred an expense that is called a salary. That is called salary debit. Salary and wages expense for how much? For $50,000, because we paid $50,000 wages to our employees. Okay, and what else? Okay, that's it, right? That is the only thing we paid to our employees. Okay, on behalf of employees, then we have to collect, or another way of saying this, we have to withhold all these taxes, the employees' taxes for them, and pay to federal governments and local governments in the future, right? So we have those called withhold income tax payable. Remember, when you have these liabilities, it always has something in front of the word payable. But whatever the name you have or name you gave to that account, it's always going to have a payable, the word payable after whatever you make up the name. Okay, and withhold income tax payable, that is $7,000. Oops. That is $7,000. Okay. And oops, $7,000. And we also have FECA payable, right? FECA payable, and that is $2,625. Okay, those will be paid off in the future. Besides all these payables, we do pay employees something with cash. That is their net payment, which is $40,375, and it's come from here. Okay, it's come from here, and this come from this calculation. Okay, so this is the journal entry we will record for the salary and wages expense, the amount we paid to the employees. And after that, the company itself also has to pay some liabilities, right? That is their payroll expense. Okay, that is their payroll expense. So from the company's perspective, okay, we have to pay, the company has to pay this FATCA tax and this unemployment tax, okay? And we know that the total payroll expense, the payroll cost is $52,875, but this $50,000 salary and wages expense we have already recorded here in that journal entry, so that is gone, right? So the only thing left here has not been recorded in the accounting system is these two numbers, okay, these two numbers. So then how do we record this, right? How do we record this? So we're going to debit something expense. Again, it is called a payroll expense. Payroll expense, payroll tax expense actually, payroll tax expense. In total, that is $2,875, right? And out of this $2,875, we have company's FATCA tax, which is $2,625, and then the other part is unemployment, right? Unemployment taxes payable, okay? Taxes payable. Remember, all these two are payable, okay? I forgot to put payable here. Payable, and that is $250, okay, $250. And in total, your credit balance equals your debit balance, which means this journal entry is finished. Okay, so this is for the first part of this chapter, and if you have any questions, please let me know. All right.